In this video, I'm going to show you why the worst gold companies perform the best in a rip-roaring gold bull market. There's lots of ways to define worst or best, but for the sake of this video, high margins and low debt equals great company. High debt and low margins equals bad company. In the left-hand column, we have the company we're talking about. Then we have the debt, whether it's high or low, and then their production costs, whether that's high or low, and then how much that stock has gone up in the last 30 days. At the same time, the spot price of gold has gone up almost $200 per ounce. First up, we have Equinox Gold. Their debt levels are pretty darn high, as are their production costs. And when you have high debt levels, that means you're more susceptible to becoming insolvent. It's more dangerous to run a business with a lot of debt, because if something goes wrong, well, then you might not be able to service that debt or pay down that debt. And then they have high production costs. High production costs means you need a very high gold price in order to be profitable. So if your costs are way up here and the gold price is here, you're barely profitable. If the gold price falls to here, you're no longer profitable. But if the gold price raises just a little bit, you can be enormously profitable. So having high costs, you have a lot of leverage to increasing gold prices. The company is going to make a lot more money if the gold prices go up and costs stay the same. So what has happened in the last 30 days to this stock when the gold prices run up almost $200? Equinox Gold is up 37%. Next up is Barrick Gold. They have low debt and they have low production costs. And compare their performance to the performance of Equinox, Barrick was up 15% in the last 30 days. Next up is B2 Gold. B2 Gold doesn't have any debt at all, and their costs are quite low. And B2 Gold has only gone up 8% in the last 30 days. For clarity, just because they have low debt and low costs does not mean you shouldn't invest in them. As a matter of fact, this is what I would recommend investing in, because if the gold price goes down, well, then you're not going to lose nearly as much money, because that company is going to be very safe in a declining gold price environment. Now, this 8% is probably less than what B2 Gold should have increased in the past 30 days. So that might be a good opportunity to pick up B2 Gold at a low price before it runs up. But I highly recommend concentrating the vast majority of your investments in companies that have low debt and low costs. Next up is Agnico Eagle Mines. They have low to moderate debt. They have pretty low costs, and their stock went up 17%. Up next is IAMGold. They have an enormous amount of debt relative to the size of the company, and their costs are high. Their costs are going to be lower after their new mine gets into production, but for now their costs are quite high. And IAMGold in the past 30 days has gone up 31%. So as you can see so far, if these numbers are low, they haven't gone up as much. For those that are higher, they've gone up more. And then you have Sandstorm Gold. So Sandstorm Gold is a royalty and streaming company, and all royalty and streaming companies have very low costs. But right now, Sandstorm debt levels are quite high. So they have a mix between low costs and high debt, and their stock went up 18% in the last 30 days. And next up, we have Wheaton Precious Metals. And this is a streaming company, so they have very low costs like Sandstorm, and they are debt-free. But Wheaton Precious Metals has significant exposure to silver. As a matter of fact, they're more of a silver company than a lot of the companies that call themselves a silver company. And in the past 30 days, since the price of silver has gone up so much, just about every silver company has also skyrocketed in price. So although they have very low debt and very low costs, the stock price still gained 15%, which makes them a bit of an outlier in this list. Next up is Alamos Gold. They have very low debt levels, they have low cost mines, and the stock price went up 12%, just barely into the double digits. Next up is Newmont. Newmont has a moderate amount of debt and also moderate costs, and their stock went up 18% in the last 30 days. And next up we have Gold Fields. Gold Fields' debt is low and the Goldfields production costs are low to moderate, and Goldfields has gone up 15% in the last 30 days. Looking at this chart here, you can see that if these numbers say low, well then the stock probably hasn't gone up as much as when these numbers say high. Because again, when you have high debt and you have high costs, your company is much more susceptible to bad things happening. When the gold price goes down, these stocks are going to go down the fastest. When the gold price goes up, these stocks with high debt and high costs are going to go up the fastest because they benefit the most from a rapid rise in the gold price.